This John Lothian News video is sponsored by
What is the SEC's market access rule?
The market access rule requires broker-dealers and anyone else who has direct market access to have controls, both financial controls and regulatory controls in place over their trading. So firms are really required to take a good hard look at how they access the markets directly and what their needs for control over credit, size of their orders, and price of their orders are, and put in place controls over those things. That means actually altering their systems to make sure they've got controls over max order size, maximum order attempts, those sorts of things, and also looking carefully at making sure they're complying on a regulatory basis with things like Regulation Show, things like Regulation NMS, and making sure their tickets are marked appropriately to manage those sorts of things.
How has this rule impacted risk management at firms with market access?
In the past, these firms had a lot of flexibility regarding what orders they could put out to the market. They could manage their risk any way they wanted. And they could react to market conditions any way they wanted, where now they're a little bit more constrained. The SEC really wants them to have some thresholds in place that they stick to and that they live through all market conditions. So that they're going to say, we want you to have, system limitations in place to control the size of your orders, to control your overall credit capacity and your overall use of your credit at your clearing firm. And you're going to have to stick to those things in all market conditions. So you can't go to try to save the farm, so to speak, from a trading perspective and put out an enormous amount of risk to sort of like maximize your trades if you're going to have to stick to the predetermined limits that you have in place.
How does the market access rule compare with the CFTC's Rule 1.73?
Both rules have a very similar aim, and it is to sort of get these firms to put in place controls before the trade leaves their door and really put the responsibility for making sure that these trades are appropriate for the market and don't present undue risk back on the firm. They're trying to say the person that puts the order to the market directly is responsible. So they have the same aim, and they are very similar.
How has the rule impacted the technology department of firms who must comply with the rule?
That is one of the most important changes that firms need to make in connection with the market access rule, is making sure their technology departments are very well versed in the rule and very well versed in the firm's internal policies. We are certainly trying to make sure that we work with firms on making sure that the compliance officer is notified of changes to the algos and making sure that those technology folks understand what changes they could make to the algorithms that could cause a problem with market access and could cause a problem with the controls. And also assisting the compliance officers in the connection with the testing of these controls to make sure they're adequate and they stay adequate throughout the changes to the system.
What compliance challenges have broker-dealers had to deal with?
Two things are complicated for a lot of the broker-dealers, one of which is making sure that they are compliant with the credit controls their clearing firm has in place for them. The SEC really does expect you to understand very clearly what your limit is at that clearing firm and have it hard-coded into your system. And the second complexity a lot of the firms have faced is the use of third-party service providers. One of the things that's important for firms to understand is that you can't absolve yourself of regulatory responsibility for regulation for the market access rule. So even if you trade through one of these platforms and they have some controls in place, when you are examined by the regulators for your compliance with the market access rule, they will expect to see you testing those controls and making sure they're working, and that responsibility really lies with you.
What can a firm expect from the regulator during a compliance examination related to market access?
They're going to want to know a little bit about your trading to understand how you came to the conclusion that these were appropriate limits. And so then you're going to also be asked for your policies and procedures. They will go over those in great detail. One of the most important things that you'll be asked for is your executive review for the year. Every firm is required to have a CEO certification that says that these controls were tested and that these controls worked and then any alterations to them were made. The most important part of surviving these exams is showing the regulators that you tested these controls and that you're sure they worked. And one of the mistakes a firm can make is to not evidence those tests appropriately, to not show screenshots, to not show screen prints, to try to tell the regulators they did the test, and then find out that they don't have enough evidence to really prove they did the test.